Hello and welcome to Soar Financially, a channel where we discuss the macro to understand the micro. My name is Kai Hoffman. I'm the JR mining guy over on X, and of course, you're a host of this channel. And I'm looking forward to bringing on a first-time guest. It's Chance Finucane, and I'm really looking forward to catching up with him because he's the Chief Investment Officer over at Oxbow Advisors. You might remember we've had Ted Oakley on a few times, but now we're speaking with a man who's actually making the decisions on the investments. So really looking forward to catching up with him and how he sees the U.S. economy developing. Lots of news, of course, this week from the macro side. We got a CPI print and jobs data just last week. So lots going on. And we got a Fed meeting next week. So we're in the middle of a lot of big macro factors, shocks, to say the least here. And we just got a press conference from President Trump as well with some interesting comments in there as well. So lots to talk about. But before I switch over to my guest, hit that like and subscribe button. It really helps out a lot. It means a lot to us, and it's a free way to support us. So thanks so much for doing that. Now, Chance, it's great to have you back, or have you on the program. It's great to meet you. Thanks so much for coming on.
Yeah, thanks a lot for having me on, Kai.
Yeah, really looking forward to the conversation here, Chance. Let's start painting the macro picture first. It's first time on the program. I need to see where your head is at, really. What is your current assessment of the U.S. economy and the financial markets at that?
What we find interesting right now with the U.S. economy is I think growth is slowing a bit, and you are going to expect inflation to accelerate, not to a huge extent, but start to increase over the course of the second half of the year. And I think that's somewhat expected now by consensus. But what's most interesting to us is not necessarily the macro movements, but how much everyone in the markets has just gone back to thinking things business as usual. And you're now trading meaningfully higher than you did on Liberation Day at the start of April. When we look at valuations, things look a little bit overpriced to us. And it seems as if everyone's somewhat forecasting a very rosy outlook of how things are going to go from here. And that may be how this plays out over the next year or two, but it really doesn't bake in much room for any downside if something adverse to the economy or any of these trade negotiations, tariffs, things like that. If anything goes wrong, it's not priced in and there's going to be more downside ahead. And so for us, we're always more focused on where do we need to be leaning, more about thinking about the risk or thinking about the upside. And in the first 2 weeks of April, we actually flipped to thinking about upside and quadrupled our trading activity to try to take advantage of some of that price movement. Now we're back to thinking more about risk and what's our downside with every new investment that we add to the portfolios.
Yeah, I appreciate that overview, Chance. Really, really interesting because, yes, it feels like we're in the eye of a hurricane here. I've said that in other interviews before, so if you repeat guest or repeat watcher here, I've said that before, but it feels like it. Nothing's priced in that should be priced in, like U.S.-China tariff talks. I don't think that's a done deal yet, personally. Just to mention one of the macro shocks that I see on the horizon potentially. You want to draw us maybe a bit of a list, like what type of macro shocks is the market not pricing in right now, Chance?
Well, one thing that the market does do that I don't know if President Trump and his team are thinking this way. I think they were to an extent, but the rate of change or the direction of movement, whether things are getting better or getting worse. So if we historically in recent years have had a tariff rate, just to use that as an example, of about 2.5% against other countries around the world, if they had just gone straight from 2.5 to 10 and left it there, it would be perceived as a negative. Everyone's focused on that increase in the tariff rate. What's that going to do to inflation? What's that going to do to consumer demand, growth in the economy? But instead what they did was they went from 2.5% to proposing a really high rate, but now they're bringing it back in, and everyone's focused on the fact that the rate is not going to be as bad as what we all thought a couple of months ago, which makes people think positively. But to your point, just using the U.S.-China negotiations, you saw that headline come out here in the last couple of days that they're coming to some sort of an agreement, or there's a little bit of agreements on rare earth metals and a little bit of export restrictions being withdrawn a bit from the U.S. side, while China sends more of those metals back to the U.S. It's not a full agreement, but what was most intriguing to us is that news comes out. That would seem to be a very important news piece. The market hardly moved, which tells us that that's already been priced in, that everyone just assumes it's all going to go okay. And if that's where everybody's at, that's not leaving much room for something going wrong in those negotiations, or the tariff rate being left at a level that's significantly higher than everyone was assuming. And that's going to impact what's going on in the economy around the world.
Yeah, it's like one thing I've noticed this week as well, once we got the CPI print, is like the tariffs are not really reflected in the inflation data yet. They haven't really seeped through yet. Like, what do you make of that? And like, how long do you think that lag will be?
We've heard a few months. So there's two competing things with the tariffs. There's the idea that prices are going to go up. There's going to be some sort of a pass through. And best as we can tell, the companies that have talked about it, it seems like they're going to probably try to pass through about half of the tariff costs that they incur onto the end customers. The competing factor with that is you've seen a little bit of a change in consumer demand and consumer spending in certain areas where I think everyone's sort of in wait and see mode. There was a big jump in activity ahead of the tariff announcements where people were starting to think like, oh, let's try to front load our purchases before anything happens if prices are going to go up. Now we're kind of in a lull where everyone's kind of wait and see what happens. We'll see. I know President Trump mentioned that he's going to be sending letters out to countries here ahead of July 9th when that 3-month reprieve kind of goes away. We'll see what that leads to. But companies that have talked about this said that once they have more clear guidelines on what the tariffs are going to be, they would expect to pass that through in the following few months. So you should start to see an impact of this in the second half of the year. The thing is, I don't even think that's necessarily in some of the inflation forecasts that we look at. And you still have inflation looking like it's going to accelerate back towards 3% in the back half of 25.
Yeah, it's an interesting discussion because the market, as you said, like is not pricing it in at all. It's completely ignoring it. And maybe one commodity we need to talk about before we talk gold later on in the conversation here is oil, of course, and the impact of the oil price and gasoline prices on inflation. I think it was minus 12% in the CPI print. That was part of that was gas prices. How important is oil to the inflation print in the U.S. economy right now, especially a low oil price?
It does move things, and just seeing the price of oil heading back towards $70 a barrel, that's going to accelerate the inflation print over the next couple of months if it holds there. I think where we're looking at it from a portfolio perspective, especially in our high income strategy, on average, we have about, say, 10, 12% of that portfolio exposed to energy companies. The core of that are a few really high quality pipeline businesses that are based in the US. But when we see an opportunity to add and we think that the price of oil could trend higher or it could be a good environment for commodities in general, we will add to that. Right now, our exposure to the energy sector and that high income strategy is closer to 15%. And we've really been adding to that over the course of the last month or two to try to take advantage of what we think is going to be an increasing inflation environment in the back half of the year.
So that is your picture. Is the inflation is increasing towards the back half of the year? Like you mentioned 3%. Is that your internal target rate at Oxbow?
Yeah, I don't think we're heading back to the 7-8% that you saw in 2022. But there's important ramifications for just the fact that inflation could trend back higher, even if it's only going back up by 50 or 75 basis points from that 2.3% CPI level from a month or two ago. That was the cyclical low for inflation. What that means is the Fed and Chairman Powell really doesn't have a need to try to lower rates. And if you're not going to lower rates, that impacts how we want to allocate in our portfolios. For as long as we can get a free 4% short-term treasury yield, that's a good base to have in multiple strategies that we manage. And then we'll try to take advantage in some riskier asset classes when we see opportunities. But it's hard to see how you're going to see valuations really meaningfully expand further when, as we discussed, we see this very rosy outlook that's embedded in market prices. And yet, if rates are not going to come down further, what's going to be that additional boost the market gets to accelerate higher from here?
You just mentioned the Fed, and I need to follow up on that with you because we have the FOMC meeting next week, of course, and everybody's expecting nothing's going to happen. Rates are going to stay at 4.25. I think it is right now. What data is the Fed looking at, and what should they be doing, in your opinion, here, Chance?
It doesn't seem like they really need to be doing anything right now, and Powell and his team know that. So if they're looking at inflation and employment. Inflation has improved over the last few years, but it's still definitely above 2% and could be trending a bit higher over the next 6 months. On the flip side, employment is softening, but it's still doing okay. It's not pointing to a clear recession. So there isn't any data point that they have to really meaningfully move in terms of how they're communicating or what they're targeting. they can kind of just let this play out. And if markets are going to be near record highs and look pretty calm, that's not going to force their hand either. So I wouldn't expect anything to really change in terms of how they've been talking in recent months. And it doesn't look like anyone's even expecting a cut until at least September. And that even seems like it could be pushed back further unless something really starts to break in the economy.
Yeah, we need to talk about recession expectations as well. I'm curious what your forecast is at Oxbow Advisors. They used to range from like 90%. That was Steve Hanke, who we'd on, to down 35%. I think Jerome Powell even said 35% at the beginning of the year. So I'm curious, what's your internal number here, Chance?
I think we've given up on trying to have a clear numerical forecast. Recessions are so hard to pinpoint right. The way that I would describe we try to look at it is that idea of like, you can just look at prices and sentiment and where people are positioned and just say, do we need to be more focused on the risk side of our portfolio? Or is this the time that we can really start swinging and thinking about upside for the next 2 to 3 years? And when we look at where things are today, we're more focused on risk and managing that and making sure we don't take too big of a loss in anything if something happens to not go our way. And we would think about it less in terms of prediction and more about being prepared. So when we had that decline, that pseudo bear market in early April, the stock market peaked in mid-February, went down for a couple of months. Depending on which index you were looking at, you had declined near 20% or a little bit more than that. Our 3 strategies that we managed really performed the way that we wanted them to and held in quite well so that we don't have to make up a 20% loss and get at least a 25% return to get back to break even off a previous high. We're coming in from a much smaller loss and can build from there. And that's really what we want to do in that kind of an environment.
JD Vance yesterday said, I tweeted yesterday or posted on X that Jerome Powell is sort of committing monetary malpractice. And I'm paraphrasing a little bit, but monetary malpractice is a direct quote from his tweet. What would you answer to that from your point of view right now? Is the Fed doing a good job?
I would describe that, and this is not meant to be political either way. It wouldn't matter who's in office if someone said something like that. I think that's a case of, if you're talking about like somebody managing a hedge fund, they talk about it as talking their book. I think anybody in the White House or part of the current presidential administration would prefer lower rates rather than higher rates because it just helps things flow more smoothly. But whoever's in the Federal Reserve needs to be able to think about all the different factors at play that they're responsible for managing. If the economy is still growing like it is today at a low rate, but it's still growing, employment is softening, but it's still holding in okay. You're not seeing negative employment numbers on the monthly reports like you did in past recessions. And on the flip side, you've got inflation that is within a more reasonable range between 2 and 3%, but it's not falling further from here. Cutting rates to us would be a little bit more of a concern. And we saw that happen last year when they tried to cut rates, and that was right at the bottom of inflation, and things started to go back up.
Absolutely. Like really curious. Like too slow Powell is another term Trump used recently. And my question is like last year, Jerome Powell sort of regretted not cutting rates back in July. Now, when it comes to the fall, like, do you think in October he will say the same thing?
It's hard to say. I don't have a great view. I think more just trying to follow. I would say we're more just trying to follow what the reaction is in the marketplace, trying to predict what the Fed's going to do. I think when we were sitting at 0 rates and realizing they had to go way higher, trying to forecast a huge move like that, I think that's the sort of move you're looking at. Whether he's going to cut 25 basis points or 50 basis points, those are more marginal incremental decisions that I think the total valuation of the market and where everyone's positioned from our vantage point is the bigger thing to pay attention to, rather than are they going to cut in July, or are they going to cut in September, or not at all this year. I don't think that's going to make as big of a difference.
Yeah, I was going to say from a market impact, there's lags anyway that take place. It's more of a, what do you call it, psychological message that's being sent when you cut as well. That's probably a good summary as well. We got to talk the Rosy markets real quick before we talk other asset classes. You touched on it. Rosy market outlook. We're back at 6,000 points in the S&P 500, which is like for coming from the gold space and the miners. I'm a bit disappointed because I was hoping this be our year, just our year, and we wouldn't have to fight with for money or returns with a generalist in the S&P 500. But yet we're back at 6,000. My point is though, like, how did we rebound so quickly? You said you were playing it, of course, as well. A lot of retail buying. So I'm curious, like, what is really driving that, and where's that rosy mood coming from?
Yeah, I think there is a bigger retail crowd now. You see all the activity in zero data expiration options in the index or key individual stocks, whether it's NVIDIA or Tesla. And we've got a 16-year run here where any bear market that happens, whether it's 2011, 2015 and 16, 2018, 2020, I guess 2022 would have been the longest one, but that was less than a year. And then we just had this blip here earlier in the spring of 25. Everyone's been trained that even if the market goes down 20%, that's an automatic buying opportunity. And if there's anything that directionally says that the economy is what people feared is going to be less bad than anticipated, that's all they need to then just push all the chips back in and keep buying. So we're not going to try and fight that. We've got our own process, and we saw things fall across the board, and we were able to do some buying and pick out companies to add to within our current portfolio and add a couple new ones that we're happy with the performance since we added. But from this point, I would say you're looking at a market that's trading at 22 times forward earnings. If you just look at the last 10 years, when the market has become more tech dominant, the average is about 18 times. So valuation doesn't say that it's got to come back down to the average over the next 6 months. It could happen anytime, or it could keep going higher. But we know that this isn't the best price to be pushing in and buying a lot more stocks. So we're just reticent to add a lot to risk. We're going to keep picking our spots and wait for a better opportunity.
No, fantastic. Like, Chance, in one of your recent videos, you used the term margin debt, and that you're following that and taking a closer look. And I hope I'm not placing it here out of context, but explain what you're looking for there, because it's an interesting indicator that I haven't heard anybody else talk about. So I'm curious to hear what is it telling you right now?
Sure. So the margin debt chart was somebody had put together a calculation, in essence, looking at margin debt as a percentage of GDP, because margin debt is a lot higher today than it might have been 30 years ago. But relative to the total economic output, you can get a better idea of the ratio. And margin debt is when investors are really confident that they're right. That's the amount that they borrow to put even more into the market, into their favorite stocks they want to own or options they want to buy. And so when you see margin debt really get high, and we're basically at a record level similar to past major peaks in the market of the past 30 years, that signals to us that the optimism, the exuberance is out there, is in full, as full as it could be. And that leaves a lot of downside. The one catch with margin debt is that it's not a leading indicator. It doesn't say that because it got to this high level, now we're going to go down for the next 6 to 9 months. It's a coincident indicator. It will go up and down with the market. But when we see a record level of margin debt as percentage of GDP, that suggests that if and when there is a decline in the market and a decline in margin debt, it could be substantial. And we want to be prepared for that so that we don't have a huge loss in the case of the market having a huge loss for some reason.
Like, I think you mentioned in the stream before that there are some comparables, some historical comparables. Can you redraw those like images for us? Like, how important are those?
Yeah, well, the two that pick out over the last 30 years were the peak in the dot-com bubble and then in 2007. And those are convenient because you had 50% declines over a couple of years in each case afterwards. I don't think we're trying to say that this is going to have a 50% decline over the next 2 years, but you're trying to map out potential scenarios. And so think about it this way. If we're at 22 times forward earnings, there's not a lot more valuation multiple expansion you can have. I don't think it's going to go to 30, at least not sustainably. So there's not much more expansion there that you're going to have. And then it means all of the growth in the market has to come from earnings growth of the companies in the index. This year's growth, if there's no economic break of about 8%, seems about reasonable. But the expectations for the next 2 years after that, in 26 and 27, you're looking for 12 to 14% earnings growth on the street. That just strikes us as too high when we already have an economy that's at peak profit margins. We're not coming out of a recession. What's going to drive that acceleration over the next multiple years? So best case scenario, you're looking at 10% growth a year on the upside. And then the downside, if something really breaks, is you go from 22 times earnings down to 15 times, which was the low in 2015, 2018, 2020, 2022. You can get back down to that level. That's a 33% loss in the market right there. And in a recession, you have earnings decline. That earnings forecast is not going to hold up, and that would be an additional drop. So that's where we're trying to pay attention and stay in companies that we think we have a lot of visibility on their cash flow generation. And there's a pretty clear trading history where, if we're buying something like McDonald's or Yum Brands that normally trades at a low 20s PE multiple, it's not going to drop to 12. It's a very consistent business that we can rely on in an adverse economy.
Yeah, no, I appreciate you clarifying that, because it's an interesting indicator and model to look at, of course. We spoke stock market, we talked Fed, we talked inflation. We got to keep going through the asset classes here. I know you touched on the bond market earlier, and you're quite happy with a 4% yield right now. But how do you see the bond market developing right now? 10-year yield is dropping a little bit as we speak today, but not too concerned there. I'm curious what your thoughts are on the bond market here, Chance.
Yeah, it's an important distinction you're making there. So we are very happy. We've had go through many years up until the last few years with zero short-term treasury yields. And that's a difficult environment when you're trying to generate some income for your clients' portfolios on a risk-free basis. Now you can get a risk-free 4%. And we are really focused on staying at the short-term end of the bond curve. So most of our, almost all of our bond exposure is maturities 2 years or less. And that makes up a significant part of our portfolios as the base capital. We've tried a couple of times here in the last few years to trade opportunistically at the long end in the 10 or 20 or 30-year treasury bond. It's just very difficult to do, because it's possible that we just started a new secular trend in bond yields. If you look at the past century of movement in bond yields, they tend to move in these 30 to 40 year cycles. We just had a downward shift in yields from 1982 to 2020. And since 2020, it's not just the US. You can look at the UK, Japan, Germany. You've got yields trending higher on government bonds in developed markets around the world for the past 5 years. And you can try to opportunistically buy and hold for a few months. But I think what we've realized is it's better to just stay at the short end. And on top of that, we look for opportunities in corporate bonds. If we can find something that matures in 5 years or less, that we can get a 5% yield. We found a few things like that we've added to the portfolio in the high income strategy, but really trying to stay short end, risk-free, and not get caught in this potentially secularly rising rate environment.
Are you staying domestic with corporate bonds, or are you looking abroad as well?
Just domestic for us. I think we try to stay as simple as possible. There was one time in the last couple of years that we saw an opportunity with emerging market bonds that were US dollar denominated, and got a decent result out of it. But I think primarily just staying domestic.
No, fair enough. Appreciate that. And maybe a quick follow up on the bond market. We got to move on. We got to talk gold here in a second, Chance. But term premium, like what would be attractive for you to go into a 20 or 30-year bond, or if they were issued? Like what would be attractive? Is it 6%, 7% at the current risk environment? In the current risk environment,
it could be something like that. I think the only thing that would make us want to go into the long-term bond is if we saw, if you look at past eras where you were in a rising rate environment like the 1970s and early 80s, if you went into a recession, you would see rates drop on the long end, even in a high inflation environment. So if we saw data that we felt really confident that this is a recession that we're in, Everything's coming down on the riskier asset classes, and there's room to run lower on long-term treasury rates. That'd probably be the only thing that would make us really want to jump in. So it'd be more that rate of change rather than an absolute level that would say like, oh, now we feel like we're being compensated.
Gotcha. No, I really appreciate you clarifying that because term premiums have been discussed here before. So I was curious what your take on that topic is, right? Chance, before we get to gold, I'm teasing everybody. It's like a bit carrot and dangling everybody along here a bit. But we need to talk US dollar real quick as well. It has been dropping 98 on the DEUTSCHE, or below 98 actually on the DEUTSCHE as we speak here, Chance. What is your take on the US dollar? Where is it headed? And DEUTSCHE, of course, versus other currencies. But what's the role of the dollar?
Yeah, it'll be interesting to see. I mean, I think you can make the case that the dollar will continue weakening. This is the worst start performing wise for the US dollar to a year outside of 1 year in the last 50 or 60. So it's definitely a record level underperformance of the US dollar relative to other currencies. You could make the case that that would continue. It's a good sign for gold, which we'll lead into that. It seems like a lot of central banks around the world are starting to reduce, not in a huge way, but they're pulling back over the last 3 or 4 years on some of their US dollar denominated assets and funneling some of that into gold, which we'll get to in a minute. But the one thing that makes me not want to say, oh, US dollar weakness absolutely going to continue is when you look at the positioning of traders in the currency space, everyone's currently positioned for the dollar to continue to weaken. And usually when that happens and everyone's on the same side, it could keep going, but it's hard to say that there's a lot more downside left. So we're not trying to position any parts of our portfolio based off of a currency call. We kind of just let that fluctuate however it needs to. And when we want to buy more precious metals or we want to buy international stocks, it's on the merits of that specific asset class or that company or industry rather than, oh, this is a call on currency movements.
Now, interesting take there, because I'm curious, like I have to follow up, Chances, like why are you, I'd say, like for lack of a better term, like so confident that the worst is behind us here in the US dollar sort of devaluing right now? What's giving you confidence that that trend might actually reverse and the US dollar might gain strength again?
Well, not necessarily saying that it's going to reverse. I'm just being mindful of all the factors involved. So when you've got trader positioning that is already very short, there's a chart you could use that just shows that whatever side they're on an intermediate term basis, so over the next 6 to 12 months, there's a chance that that could reverse and you see a stabilization in the dollar relative to other currencies or a little bit of appreciation. Maybe that doesn't affect the structural trend over years to come if this continues what's been happening. But it's more just sort of keeping an eye on all the factors at play that it doesn't all point one direction. If everybody agrees that, oh, this is all going to get worse, then there might be a counter move in the interim.
Maybe one last question on the US dollar, because a weaker dollar would play into the policy hands in Washington, potentially trying to balance the trade deficit a little bit, meaning making it cheaper to export more from the US and hence maybe decreasing that import export gap a little bit. But do you take that into consideration at all when you look at the dollar?
Not a lot. I mean, it might be a desired outcome for them, but I think that export import gap, we'll see how much tariffs can start to close that. But things have changed so much over the last 25 years in terms of how much is manufactured and exported out of the US versus what's brought into the country here. I don't know how much of a huge difference that's going to make. When we look at things like the deficit, we're looking at things like the big beautiful bill that's being put in place and just how much of a 180-degree turn that is from DOGE the first few months, and now it looks like we're just back to focused on spending, and that's been the case for multiple decades now, regardless of who's in office. And then just looking at how much the debt ceiling as a proxy for U.S. government debt keeps going up. Just those are the things that we're focusing on as much or more as the export import gap.
No, fantastic. Appreciate your opinion on that, Chance. Now we got to talk gold. We talked all the other asset classes, and I saw your video. You always put out one every 2 weeks, so you're actually due for another update here any day now, Chance. But you were bullish on gold. I'm curious. 2 weeks later, are you still bullish on gold? And what's your forecast for the precious metal here?
Yeah, we are. Actually, I mean, we're bullish on gold. We've been most incrementally adding to our silver positions in recent weeks. But we take a very long-term view on this, and you can break down multiple reasons for that. But we consider it a core allocation to a certain extent in each of our three strategies. It's anywhere from 2 to 10% of our holding in each of the three strategies. And a portion of that could be in the actual metal, whether it's gold or silver. And then also trying to select from some very high quality businesses that are exposed to precious metals. So it's kind of a combination of the two. And yeah, we've been incrementally building up our stake. The high income strategy is the one that we have the most exposure to. I think at this point it's about 9% of the portfolio that's gotten exposure. That's pretty evenly split between the precious metals and then companies that we like. So no, it's something that we've been holding for years and plan to continue to have an exposure to for years to come.
Yeah, same fundamentals for gold, for silver than for gold. Is that you throw them in the same bucket, or do you look at them separately?
Somewhat separately. So I think we view silver because there's that industrial component to how silver is used. They move a bit differently. But one thing we did notice was there is still enough of a link between silver and gold that when that silver to gold ratio gets really low, compared to its historical cycle, it moves up and down. Which one is preferred between the two, and it's been very low relative to gold because gold's had this amazing run the past couple of years. And now you're starting to see silver catch up a bit. So I think that's one factor for why we're building up a little bit more silver exposure.
No, fantastic. Chance, I do have to ask you one last question here because you touched on it. You're looking at businesses in the mining space. So can you clarify who you don't have to mention names, Chance, but I'm curious, are you looking at the big producers? Are you looking at the mid tiers? Are you looking at royalty companies or just the drilling operators, for example? I'm curious, who are you looking at?
Yeah, so I think it's an important distinction, especially considering your expertise, and I'm sure a lot of the viewers that you have. We're not specialists in this industry, and I think you got to have a real specialist knowledge to really dig into the junior miners and all of the players involved. For us, we prefer trying to go after the larger businesses that are well capitalized, have a good track record of performance and capital allocation. And it's a mixture of miners like Agnico Eagle Mines and some royalty businesses like Wheaton Precious Metals, and trying to just have a good allocation there in companies that we think the management teams are doing the right thing. And we just want that component to be able to participate if we're right about the commodity price moving higher, rather than any poor decisions by management and we miss out that we should have just had it in the metal to begin with.
No, it makes a lot of sense, and the names you've mentioned are no big surprises. Quite honestly, they are high quality names in the space, and I think there's lots of room still to run for them as well. If I look at the GDXJ in terms of like index performance, there's lots of room to still run here. Chase, maybe to Chance, sorry, maybe to summarize here real quick. Overall, you would say that Oxbow is actually more defensively positioned right now in this market, maybe going into the summer. If you were to invest $1 million right now, if you were to find $1 million under your pillow tomorrow, and again, this is not financial advice or anything, and everybody's situation is different. We all know that. But how would you allocate that money today?
Yeah, well, I mean, what we notice whenever we're talking to our clients or when we talk to people that are interested in potentially becoming clients, everyone's in a different situation and everyone's got a different relationship with money. So it really is a personal conversation as to, you really just want to focus on being conservative and hanging on to what you have? Do you want to generate a lot of income and have something you can live off of? Or do you want to try and shoot for a little bit more growth that might have some more volatility to it, but have that potential for additional expansion in your portfolio over time? And it's usually a mixture. So if you're just looking at the way our portfolios currently are, we've got half of all three strategies right now, at least half sitting in short-term treasuries. Given valuations and riskier asset classes, we think it's prudent to take that free 4% and just wait for better opportunities like we had for a short time in early April. We think there's definitely room to have a little bit of exposure in energy, a little bit of exposure in precious metals. And then we also do a little bit in other commodity-linked companies, whether that's agricultural or base metals. We think that's important for the next 5 to 10 years, if we're going to go into an environment where maybe inflation's a bit more prevalent than what we had over the last 20 or 25 years when we were in a disinflationary economy because of labor efficiencies from globalization, and there was a lot of drilling and whatnot. We're in a little bit different environment looking ahead to the next decade, and you want to be a bit more diversified than just stocks and bonds. So short-term treasuries, 1, commodities, 2, and then 3rd, we really like owning some high-quality businesses that we think we're paying a fair price for, that can grow their business value at a double-digit rate through an economic cycle, and have a lot of cash flow consistency. So we don't have to worry about an abrupt earnings announcement that all of a sudden they're going to miss their earnings by 50%. That's where you really get hit. We like owning the ones that they've proven, they essentially have already won, and now they're just running up the score and continuing to invest and grow share in their industries.
No, fantastic, Chance. It was a great pleasure to catch up with you and have you on the program. Where can we send our audience? Where can they follow your work, Chance?
Yeah, if you'd like to learn more, you can go to oxbowadvisors.com. And our team also has put together an excellent YouTube channel if you look for us at Oxbow Advisors.
Fantastic, Chance. Thank you so much for coming on. It was a real treat. We'll have to do this again after the summer, and all the best. Enjoy the summer break. I hope you get one, and I hope it's not tumultuous out there in the market. So all the best, Chance. We'll catch up soon. Everybody else, thank you so much for tuning in to Soar Financially. Hope you enjoyed this conversation with Chance Finucane here of Oxbow Advisors. I tremendously did. Always good to get a new perspective, fresh perspective on things. I like the look at the margin debt. It's an interesting one because nobody else has mentioned it on the program before. So I'll take a closer look at that moving forward as well. And if you haven't done so, hit that like and subscribe button. It helps us out tremendously. It's a free way to support our channel, and we appreciate it a lot. So thanks so much for tuning in. We'll be back with lots more here from Soar Financially. Take care out there.